Hello friends. Welcome back to our 6th class of Forex Preschool. So today we'll learn about Margin Trading 101 to understand how your margin account works. In this session we have so many things to discuss, so we have divided this session into two parts. So let's start the first part of Margin Trading 101. So first let me tell you about what is margin trading. The biggest appeal that Forex trading offers is the ability to trade with margin. But for many Forex traders, margin is a foreign concept and one that is often misunderstood. Like Bob. Bob sure knows his fried chicken and mashed potatoes but absolutely has no clue about margin and leverage. Margin trading gives you the ability to enter into positions larger than your account balance. With a little bit of cash, you can open a much bigger trade in the Forex market. A lot of new traders do not understand the concept of margin, how it's used, how to calculate it, and the significance that it plays in their trading. Do you know what margin actually is? What about used margin? What is free margin? What is margin level? What is a margin call? What is a stop out or margin closeout? As you can see, there is a lot of margin jargon used in Forex trading. Before you choose a Forex broker and begin trading with margin, it's important to understand what all this margin jargon means. Terrible things will happen to your trading account like a margin call or a stop out. But you won't even know what just happened or even why it happened. If you really want to understand how margin is used in Forex trading, you need to know how your margin trading account really works. This starts with understanding what the heck some, really important, numbers you see on your trading platform really mean. We'll call these numbers your margin account's metrics. For example, take a look at the MetaTrader 4, also known as MT4, trading platform. The metrics above are all intertwined. A change in one causes a change in another. As a trader, you need to be aware of the relationships between them before ever entering a single trade on a live account. Don't be like Bob. Where certain metrics fall below a certain value, bad things will happen. So you need to know what these metrics are. You also need to know what these bad things are. Make sure you have a solid grasp of how your trading account actually works and how it uses margin. So let's dive right in. A margin trading account displays the following metrics: balance, used margin, free margin, unrealized profit and loss, equity, margin level. A metric is just a measurement of something. This means that every metric above measures something important about your account involving margin. For example, the balance measures how much cash you have in your account. And if you don't have a certain amount of cash, you may not have enough margin to open new trades or keep existing trades open. Depending on the trading platform, each metric might have slightly different names, but what's being measured is the same. Let's take another look at the metrics on MetaTrader 4. You'll notice that it looks like that used margin is not displayed. But it's there. MetaTrader 4 just displays it as margin. Here's another example of account metrics from a different Forex trading platform. Same metrics as MetaTrader 4, but different labels. Don't worry about the different labels right now, we'll explain each margin-related metric in a way that you'll be able to know which metric is which regardless of the exact label. We'll also let you know what other names that a specific metric is also known by. And at the end of this Margin Trading 101 course, we'll provide a helpful cheat sheet for all this margin jargon. Let's now discuss each metric one by one in detail. We'll start with an easy one. What does balance mean? In order to start trading Forex, you need to open an account with a retail Forex broker or CFD provider. Once your account is approved, then you can transfer funds into the account. This new account should only be funded with risk capital, which is cash you can afford to lose. The account balance or simply balance is the starting balance of your account. Basically, it's the amount of cash in your account. Your balance measures the amount of cash you have in your trading account. If you deposit $1,000, then your balance is $1,000. Here you can see the balance before deposit and after deposit. If you enter a new trade or in trader lingo, open a new position, your account balance is not affected until the position is closed. This means that your balance will only change in one of three ways. When you add more funds to your account. When you close a position. When you keep a position open overnight and either receive or pay swap or rollover fee. Since the topic is about margin, The concepts of swap and rollover aren't really related, but for thoroughness, we'll quickly describe it since swap fees do affect your balance. Just know that there's a difference between a trade that lasts a couple hours and a trade you keep open overnight. Let me tell you about rollover. The procedure of moving open positions from one trading day to another is called rollover. Most brokers perform the rollover automatically by closing any open positions at the end of the day, while simultaneously opening an identical position for the following business day. During this rollover, a swap is calculated. A swap is a fee that is either paid or charged to you at the end of each trading day if you keep your trade open overnight. If you are paid swap, cash will be added to your balance. If you are charged swap, cash will be deducted from your balance. Unless you're trading huge position sizes, these swap fees are usually small but can add up over time. The concept of swap and rollover is beyond the scope of this lesson and will not be discussed further, but we just wanted to cover it briefly for accuracy's sake. Now that we know what balance means, let's move on to understanding the concepts of unrealized profit and loss and realized profit and loss and how they affect your balance. So let's discuss about what is unrealized profit and loss and floating profit and loss. In your trading platform, you will see something that says unrealized profit and loss or floating profit and loss with green or red numbers beside them. In this lesson, we explain what unrealized profit and loss and floating profit and loss are. When trading, there are actually two different types of profit or loss, also known as profit and loss. Both are important. Let's discuss the difference between the two. Unrealized profit and loss. Unrealized profit and loss refers to the profit or loss held in your current open positions, your currently active trades. This is equal to the profit or loss that would be realized if all your open positions were closed immediately. Unrealized profit and loss is also known as floating profit and loss because the value is constantly changing since your positions are still open. Your unrealized profit and loss continuously fluctuates, or floats, with the current market prices if you have open positions. For an example, if you currently have an unrealized profit, if price move against you, the unrealized profit can become an unrealized loss. Realized profit and loss. A realized profit is profit that comes from a completed trade. Same thing with a loss. A realized loss is a loss that comes from a completed trade. In other words, your profits or losses only become realized when the positions are closed. This is the only time when your account balance will change to reflect any gains or losses. If you closed a position with profits, your account balance will increase. If you closed with losses, then your account balance will decrease. Profit isn't real until it's realized. The difference between realized and unrealized profit is subtle, but it can mean the difference between a profitable trade or a losing trade. It is important for traders to clearly know how to differentiate between realized profit and loss and unrealized profit and loss. Realized profits are gains that have been converted into cash and added to your account balance. Realized losses are losses that have been converted into cash and deducted from your account balance. In other words, for you to realize profits from a trade you've made, you must receive cash and not simply observe the value of your trade increase without exiting the trade. Unrealized profit is theoretical profit or paper profit that is currently available, but could be taken away at any moment if the price moves against the trade. When it comes to love, think about the one that got away. At one point in your life, he or she was an unrealized spouse. You never built up the courage to pop the question and now you're forever heartbroken with the realized loss of the perfect spouse. If you have not closed out of your position and realized your gain, you could still lose some, or all, of your profits. Realized profit is real profit that can no longer be affected by price changes because it is no longer part of an active trade. It is real money that is added to your balance and can be withdrawn from your trading account and transferred into your bank account. Let's move on and learn about the concept of margin. So first let me tell you what is margin. When trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital is known as the margin. For example, if you want to buy $100,000 worth of USD/JPY, you don't need to put up the full amount, you only need to put up a portion, like $3,000. The actual amount depends on your Forex broker or CFD provider. Margin can be thought of as a good faith deposit or collateral that's needed to open a position and keep it open. Margin is not a fee or a transaction cost. Margin is simply a portion of your funds that your Forex broker sets aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. This portion is used or locked up for the duration of the specific trade. Once the trade is closed, the margin is freed or released back into your account and can now be usable again. To open new trades. What is margin requirement? Margin is expressed as a percentage of the full position size, also known as the notional value of the position you wish to open. Depending on the currency pair and Forex broker, the amount of margin required to open a position varies. You may see margin requirements such as 0.25%, 0.5%, 1%, 2%, 5%, 10% or higher. This percentage is known as the margin requirement. Here are some examples of margin requirements for several currency pairs. What is required margin? When margin is expressed as a specific amount of your account's currency, this amount is known as the required margin. Each position you open will have its own required margin amount that will need to be locked up. Required margin is also known as deposit margin, entry margin, or initial margin. Let's look at a typical euro to US dollar, euro against US dollar, trade. To buy or sell a 100,000 of your USD without leverage would require the trader to put up $100,000 in account funds, the full value of the position. But with a margin requirement of 2%, only $2,000, the required margin of the trader's funds would be required to open and maintain that 100,000 euros USD position. Let's take an example of open a long USD JPY position. Let's say you've deposited $1,000 in your account and want to go long USD JPY and want to open one mini lot, 10,000 units, position. How much margin will you need to open this position? Since USD is the base currency, this mini lot is $10,000, which means the position's notional value is $10,000. Assuming your trading account is denominated in USD, since the margin requirement is 4%, the required margin will be $400. So here I'll tell you how to calculate required margin. When trading with margin, the amount of margin or required margin needed to hold open a position is calculated as a percentage or margin requirement of the position size or notional value. The specific amount of required margin is calculated according to the base currency of the currency pair traded. If the base currency is different from your trading account's currency, the required margin is then converted to your account denomination. Here is the formula to calculate the required margin. If the base currency is the same as your account's currency, required margin equals to notional value multiplied by margin requirement. If the base currency is different from your account's currency, required margin equals to notional value multiplied by margin requirement. Multiply by exchange rate between base currency and account currency. The only reason for having funds in your account is to make sure you have enough margin to use for trading. When it comes to trading Forex, your ability to open trades is not necessarily based on the funds in your account balance. More accurately, it's based on the amount of margin you have. This means that your broker is always looking to see if you have enough margin in your account, which can actually differ from your account balance. If this sounds confusing, don't you worry. It'll start to make more sense as we proceed. So now I will let you know about what does used margin mean. In order to understand what used margin is, we must first understand what required margin is. Whenever you open a new position, a specific amount of required margin is set aside. Required margin was discussed in detail in the previous lesson, so if you don't know what it is, please read our What is Margin? Lesson first. If you open more than one position at a time, each specific position will have its own required margin. If you add up all of the required margin of all the positions that are open, the total amount is what's called a used margin. Used margin is all the margin that's locked up and can't be used to open new positions. This margin is already being used. Hence the name, used margin. Let's take an example. Open a long USD JPY and USD CHF position. Let's say you've deposited $1,000 in your account and want to open two positions. First long USD JPY and want to open one mini lot, 10,000 units, position. And second long USD CHF and want to open one mini lot, 10,000 units, position. The margin requirement for each currency pair are as follows. I will tell you. How much margin, required margin, will you need to open each position? Since USD is the base currency for both currency pairs, a mini lot is $10,000, which means each position's notional value is $10,000. Let's now calculate the required margin for each position. USD JPY position. The margin requirement for US dollar to Japanese yen is 4%. Assuming your trading account is denominated in USD, the required margin will be $400. Required margin equals to notional value multiplied by margin requirement. USD CHF position. The margin requirement for USD CHF is 3%. Assuming your trading account is denominated in USD, the required margin will be $300. Required margin equals to notional value multiplied by margin requirement. Since you have two trades, the used margin in your trading account will be $700. Then used margin equals to sum of required margin from all open positions. Here's a cool diagram of how used margin relates to required margin and balance. So let's move from here discuss about equity. What does equity mean? The account equity, or simply equity, represents the current value of your trading account. Equity is the current value of the account and fluctuates with every tick when looking at your trading platform on your screen. It is the sum of your account balance and all floating, unrealized, profits or losses associated with your open positions. As your current trades rise or fall in value, so does your equity. How to calculate equity if you have no trades open? If you do not have any open positions, then your equity is the same as your balance. How to calculate equity if you have trades open? If you have open positions, your equity is the sum of your account balance and your account's floating profit and loss. For an example, account equity when an existing trade is losing. You deposit $1,000 in your trading account. Beyoncé tweets that she's shorting pound sterling to US dollar. Because she's Beyoncé, you follow what she says and go short also. Price moves immediately against you and your trade shows a floating loss of $50. Equity equals to account balance plus floating profits, or losses. The equity in your account is now $950. Another example of account equity when an existing trade is winning. Beyoncé tweets again and says she's changed her mind. She's now long pound sterling to US dollar. Not only is she crazy in love, but she seems crazy in trading also. But because she's the queen bee, you follow what she says and go long also. Price moves immediately in your favor and your trade shows a floating gain of $100. Equity equals to account balance plus floating profits, or losses. So in this way the equity in your account is now $1,100. Your account equity continuously fluctuates with the current market prices as long as you have any open positions. Equity shows the temporary value of your account at the current time. Unlike a tattoo, which is not temporary. That's why equity is seen as a floating account balance. It will only become your real account balance if you were to close all your trades immediately. So now let's discuss about what is the difference between balance and equity? Let's start with a simple answer. If your account is flat or does not have any positions open, then your balance and equity are the same. But if you do have open positions, this is when the balance and equity differ. The balance reflects your profit or loss from closed positions. The equity reflects the real-time calculation of your profit or loss. The equity takes into account both open and closed positions. This means that when you're looking at your balance, it is not the actual real-time amount of your funds. Since equity includes current profits or losses from open trades, it is equity that shows the real-time amount of your funds. It's possible to have a very large balance, but very small equity. This happens when your open positions have a large unrealized, floating, losses. For example, if your balance is $1,000, and you have an open trade that has a floating loss of $900, your equity is only $100. Let's move on to free margin. What does free margin mean? Margin can be classified as either used or free. Used margin, which is just the aggregate of all the required margin from all open positions, was discussed in a previous lesson. Free margin is the difference between equity and used margin. Free margin refers to the equity in a trader's account that is not tied up in margin for current open positions. Free margin can be thought of as two things. First is the amount available to open new positions. And second is the amount that existing positions can move against you before you receive a margin call or stop out. Free margin is also known as usable margin, usable maintenance margin, available margin, and available to trade. Let me tell you how to calculate free margin. If you have open positions, and they are currently profitable, your equity will increase, which means that you will have more free margin as well. Here's how to calculate free margin. Free margin equals to equity minus used margin. Floating profits increase equity, which increases free margin. If your open positions are losing money, your equity will decrease, which means that you will also have less free margin as well. Floating losses decrease equity, which decreases free margin. Let's discuss what does margin level mean. The margin level is the percent value based on the amount of equity versus used margin. Margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade. The lower the margin level, the less free margin available to trade, which could result in something very bad like a margin call or a stop out, which will be discussed later. How to calculate margin level. Your trading platform will automatically calculate and display your margin level. Margin level equals to equity or used margin, multiply by 100%. If you don't have any trades open, your margin level will be 0. Margin level is very important. Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set this limit at 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. So friend, here first part of margin trading 101 is completed. In next video we will cover second part of margin trading 101. So stay tuned.